This is a podcast from the Business Times.
In 1Q, we saw the office and retail S-Reits reporting quite a solid teens positive rental reversion. The industrial REITs are also, especially the logistics sector, also saw a double-digit positive rental reversion.
Earlier this year, analysts were saying that S-Reits would be the net outperformers in 2024 as interest rates continue to subside. Sounded promising enough. This is Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. Now, just a few months ago, analysts pointed out that changing expectations of the high interest rate environment has once again been a contributing factor for S-Reits' underperformance. I guess the question now is, what's the outlook for S-Reits for the rest of the year? Geoff Howie is a market strategist with SGX.
Okay, we've had poor performance from an investability standpoint because of essentially global inflation and higher interest rates. And that's seen longer-term retail investors really in accumulation mode in the REITs themselves, as well as in the REIT tracking ETFs. For instance, if you look at the three Mapletree REITs, they've averaged around 10% declines in total return since the end of 2019. However, if you look at the three REITs since the end of 2015, the trio averaged 100% total returns. I guess since inception, S-REITs, they've typically been sought for investability traits like yield and stability. However, recently, we've had these tighter financial conditions and quite a fluid outlook for those conditions, and that's provided more tradability to the S-REIT sector.
Here's Deputy Head of Research, Lok Man Yi from CGS International, with her take on S-Reits' poor performance thus far.
On a total return basis, it has declined by about 7% year to date. In terms of ranking, it is the fourth best performing REIT market in Asia Pacific. And I think the underperformance is basically because rate cut hopes keeps getting delayed. And we think that in the near term, share price performance of S-Reits could be closely tied to movements in the US Treasury yields and also to the Singapore 10-year bond yields. And why is this so? I think it's because S-Reits earnings have been eroded by higher funding costs, which goes back to, the interest rate cycle. If you look at the recent 1Q results, average funding costs have risen by anywhere between 0 to 60 basis points. And having said this, we are about 2 to 3 years into the higher rate environment, and S-Reits have marked to market a larger part of their funding costs or their debt profile to market levels. So we could potentially see a peaking of funding costs over the next 18 months or so, and this will be a less of a drag on bottom line.
This means we need some good news. There's got to be some silver lining for this popular investment. Investors have turned to S-Reits for many reasons. Chief among them, stability and yield. Given things aren't looking so good now, might diversification be in order? Here's Geoff Howie again.
Well, REITs diversified already by where in the world they are investing, where those properties are located in the world. Here, in our global REIT hub, we've got as many as 17 of the trusts exclusively investing in property assets outside of Singapore. And you have the majority, though, which is 20, investing in properties in both Singapore and outside of Singapore. And I think there's just 3 that are investing purely in Singapore. You've got a lot of regional exposure there. I think you've got as many as 14 trusts with properties in Australia, 11 trusts with properties in China, 11 with properties in Japan, and there's as many as 9 trusts with properties in the US. So the S-REIT sector overall is also well diversified by the type of property in the portfolios. And REITs do seek to diversify properties and tenant exposures themselves. So diversified S-REITs now make up the largest subsegment of the sector. One of our REIT CEOs, William Tay, who's at Capital Centres REIT, he articulates it really well. He says, all in all, the geographical mix and the multi-asset portfolio allow REIT managers to diversify risks across industries, customers, and currencies.
For REIT portfolio construct, we think that diversification will pay off simply because if you look at the Singapore REIT market, there is a diversified range of REITs in different property sectors, retail, industrial, office, hospitality, and also overseas focused REITs. And when it comes to property, different sectors move in different cycles. So diversification would enable investors to derive a stable dividend stream.
Looks like we have differing views going on. Geoff from SGX doesn't think it's necessary, but Man-Yi from CGSI does. Okay, maybe we should spell out the main benefits of S-REITs versus other REITs.
We think that basically the S-REIT markets offers depth, diversification, and yield. And why do we say this? If you look at the Singapore REIT market, it is the third largest REIT market in Asia Pacific behind Japan and Australia in terms of market cap. So the market does offer depth. And then if you look at within the developed markets, S-REITs itself are yielding about an average 6.3% yield by our estimates. And if you compare to other developed markets like US and Japan, it ranges about 4+%, while Australia REITs are yielding just under 4% based on the latest market statistics. So we think that from a yield perspective, it is attractive. And thirdly, from overseas diversification, as you know, the bulk of S-REITs have overseas exposure, whether this is in part of a portfolio or in whole. And this offers investors exposure to other markets for counter cyclical property cycles. Again, back to the stability, from a dividend perspective.
Man-Yi from CGSI really seems to be behind S-REITs. Still to come, what upcoming trends could benefit S-REITs, and might our analysts have some winners for us? More in a moment.
The Business Times podcasts. Relevant, incisive, compelling content by some of the newsroom's most respected correspondents in markets, wealth management, and current affairs. Available on all your favorite audio content apps and at www.businesstimes.com.sg/podcasts.
And now, back to Money Hacks from the Business Times.
Potential pending trend of low inflation can be disturbed by your food price shocks, your energy price shocks, tighter labour markets, which edge services inflation higher.
Geoff Howie from SGX. But it's really not all doom and gloom when it comes to S-REITs. Sure, over the last 10 years, the S-REIT sector has grown at a compounded annual rate of 7%. But how likely will the current doldrums be temporary in nature? Man-Yi from CGSI.
So we are looking out to see if operating expenses, including things like utilities costs, could moderate and result in, potentially lifting NPI margins for other REITs as well. And I think in the medium term, with interest rates coming off, REITs can also reactivate the other growth driver, which is inorganic growth coming from new acquisitions.
The world is abuzz with the rapid expansion of artificial intelligence and machine learning, and that's led to a higher demand for data center space. What other trends might S-REITs benefit from?
Yeah, going into the first half of this year, if we had to say there was one potential upcoming trend that would support S-REITs, it would be a trend of low global inflation. High global inflation has seen the Fed Reserve increase its Fed funds rate over a 17-month period, March 2022. Right through to July 2023. So when you go from the beginning of March 2022, when the Fed Reserve first increased interest rates, both your global and your local REIT benchmarks have both declined 11%. If the trend is that this does go down to low inflation, this would obviously stand to benefit based on what we've seen in the past, but there are risks that potential pending trend of low inflation can be disturbed by your food price shocks, your energy price shocks, tighter labour markets, which edge services inflation higher. And this all exacerbates not just keeping your Fed funds rate higher, but your real interest rates. Very important that what's changed this year is going into the second half of the year. One has to be mindful that the S-REITs have had time to adapt to the high for longer interest rates, and thus they could be boosted by a trend of higher than expected local and global economic growth. We saw in the recent earnings season in the US, you had 2 REITs in the US beat expectations for every 1 US REIT that missed expectations. And this overall parallels the shift in focus we're seeing this year by economists and investors to moving a little bit away from not just the if and the when and the size of the Fed fund rate cuts, but just to how smooth the landing will be for the US economy. And at the moment, the jury's still out on whether it'll be very smooth or just smooth. So more growth can obviously support REIT occupancy rates. It supports rental reversions, and in turn, that produces more distributable income. And the higher property valuations that could come on the back of real growth can also reduce interest coverage ratios, which potentially provides for more leverage for the REITs to expand their portfolios. So for those trends, you've still got to remain cognizant that it's really anchored to inflation at the beginning of the year, but it's morphed somewhat this year into inflation as well as growth.
Now, the iEdge S-Reit Leaders Index has declined 12.3% for the year to May 29th, while its total return is a negative 9.5%. Even I know those aren't good numbers, but keep our chins up we must. Here's Lokman Yi from CGSI.
We think from an overall valuation perspective, the S-REITs are not expensive, trading at like 0.83 times price to book and about 6.3% dividend yield. We do think that the REIT market may be a little bit choppy in the near term, as investors take a wait and see attitude. But we also see that these are accumulation opportunities given the expectation of peaking interest rates. So we would position in two buckets. The first bucket is basically looking at large cap liquid names. And we do like CapitaLand Ascendas REIT in this bucket. And the other are basically the laggards. And within this group, Frasers Logistics and Commercial Trust is attractive from a dividend yield point of view.
Ooh, unsolicited winners pick from Man Yi. Geoff Howie, get in here.
If you're looking to pick winners, you have to take into consideration we are a global REIT hub. Most REIT hubs or exchanges across the world that do list REITs, they are going to be influenced by a tidal effect from what happens in the United States. Because in the United States, look at your global REIT benchmarks, FTSE EPRA NAREIT, for instance, the global REIT index under that series is weighed 70%, 70% to US listed REITs. So what's happening in the US REITs will affect the value and the economics when it comes to investing in REITs across the world. So tighter financial conditions in the US obviously matter. A fluid outlook for those conditions. As we said before, it is providing an element of tradability to the sector, moving those indices around on a day-to-day basis. And with the focus on inflation, and not just inflation, but now also on growth, you're going to have potential for more tradability in the sector for the remainder of the year. You've also got to look at what the policymakers are thinking. Every year you have new federal open market committee members rotate in. So we'll be looking over the next 6 months to see what the FOMC representatives from Chicago, Boston, and St. Louis and Kansas City, see what they have to say about their thoughts about rate cuts and so forth. So that's an overarcher.
A big thank you to Geoff Howie from SGX and Lokman Yi from CGSI. Next time, elections in the fourth largest economy are done and dusted. But what impact will the shock results have on its economy and your investment opportunities? This has been Money Hacks from the Business Times. I'm Howie Lim. Till next time.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.